Hello everyone, my name is Zhang Ziwen. This is our financial management assignment. We are choosing DigiGood as our assignment topic, and this is the list of our good members. First part is the introduction. Digi is a leading mobile communication bank which owned majority by Telenor ASA of Norway. In 1995, Digi became the first telecommunication in Malaysia to launch and operate a fully digital cellular network. They were also the first to offer GPRS and later EDGE in Malaysia in 2004. Digi is listed on the main board of Berhad Malaysia Securities. Digi vision is to be seen as SaaS in excellent customer experience. Their mission is to assist our customers' expectations by delivering mobile and internet service that are make for me, make it easier, and offer the best deal. So this is the further information about DigiGood.
Digi is the third largest mobile operator in Malaysia, and it provides a variety of mobile communication services, such as voice, which include prepaid and postpaid services, SMS, data plans, international roaming, international calling cards, WAP, which is also known as Wireless Applications Protocol, and last but not least, in March 2009, Digi launched 3G broadband services for.
And now, we'll move on to the part 3, the ratio calculations. There are 5 parts in this section, which I will be covering 3 of them: the liquidity ratios, activity ratios, and the debt ratios. The first ratios that is under liquidity ratios is the current ratio, which is to measure the firm's ability to meet its short-term obligation, meaning that the higher ratios the company has, the better it is for the company, as the company will have the ability to pay off the debts in short term. Based on the case itself, Digi.com Berhad's current ratio dropped from year 2011 to 2012 and increased slightly in year 2013. Although the increasement is seen from year 2012 to 2013, but the ratio is still lower than what it was in year 2011, and that is not a good thing for the company. Next, we'll move on to the second ratio, which is the quick ratio. Quick ratio is basically the same as current ratio, except that it excludes the inventory from the calculation, as inventory might not be able to convert into cash as fast as what other current assets do. In this case, Digi.com Berhad's quick ratio has the same situation as its current ratio, which dropped from year 2011 to 2012 and has increased slightly from year 2012 to 2013, but still having a lower ratios compared to year 2011 makes it not so benefiting the company. And next, we'll move into activity ratios, which include the inventory turnover, average age of inventory, average collection period, average payment period, and last but not least, total asset turnover. For the inventory turnover, it simply means the speed of the company to convert its inventory to cash in a specific time, which Digi.com Berhad did a very good job based on the year 2013 performance. Second will be the average age of inventory. It is to measure the number of days the inventories remain in the business, and which Digi also had a very good improvement in it. Thirdly will be the average collection period. It is the average number of days the company requires to collect payment from its current credit customers, and Digi.com Berhad didn't perform well in it. Second last will be the average payment period, which is the average number of days the company needed to pay off its trade creditors, which Digi did not do well also in year 2013, although improvement was seen in year 2012. Last but not least is the total asset turnover, which indicates the efficiency with which the company uses its assets to generate sales, and Digi performed very well in this part. The third part is the debt ratios. Debt ratio measures the proportion of total assets of the company financed by creditors. For example, in year 2011, 70.98% of the total assets of Digi.com Berhad were being financed by debts. The higher the ratio is, meaning the more risk that the company is having, and it has a greater degree of debts. In this case, Digi.com Berhad is not good at all, as its debt ratios were all very high in all 3 years. But still a slight improvement is seen in year 2013. The second ratio will be the times interest earn ratio. Times interest earn ratio measures the company's ability to make contractual interest payment. For example, in year 2011, Digi.com Berhad had 24.6 times of ability to pay off its interest, and in this part, Digi.com Berhad was very good in it, as based on year 2013, it had doubled the ability to pay off the interest expenses from year 2011.
I'm going to talk about profitability ratio as well as market ratio, and profitability ratio will cover all this below. First, let's talk about gross profit margin. Gross profit margin is actually the remaining money after the firm has paid for its cost of goods sold. In this case, in 2011, the gross profit is actually increased to 0.73 cents for every 1 ringgit of their sales. And when it goes to 2013, it's slowly declining. So in this case, Digi Berhad does not generate more gross profit in 2013. Next is operating profit margin. It used to measure the percentage money before the tax, interest, and preferred stock dividend are being deducted. So in this case, in 2011, it actually reached the highest by 0.51 cents of operating profit for every 1 ringgit of sales. And when it goes to 2012 and 13, it's slowly declining, and in 2013 it reached to 0.30 cents from 1 ringgit of sales. So it's shown that Digi Berhad performance is declining. And next we goes to net profit margin. It used to measure the percentage earned by the company after the cost and expenses, including interest and taxes, are being deducted. So in this case, in 2013, it actually reached the highest by 0.25 cents of net profit margin. It means that the company is good at controlling their costs. And next is earning per share. Earning per share represents the number of the company profit earned during the period of each outstanding common stock, and it indicates the company profitability. So in this case, in 2013, it reached 0.22 cents for every 1 ringgit of their common stock equity. And in this case, Digi Berhad actually made a lot of profit compared to the previous 2 years. And next is return on total asset. It measures the overall effectiveness of management in generating their profit. In this case, in 2013, actually it reached the highest by 0.45 cents from their common stockholders for every 1 ringgit of their total asset invested. So in this case, Digi Berhad is actually doing very well because it's able to generate more profit compared to the previous 2 years. And last but not least is the return on common equity. Return on common equity measures the amount of money earned from their common stockholder invested in the company. In this case, in 2011, it reached to 88.9%. However, when it goes to 2012, it reached the highest by 461.4%. And when it goes to 2013, it slowly decreased again to 258.1%, which is bad news for the company. And next, we are going to talk about market ratio and include price earning ratio and market or book ratio. Price earning ratio is actually the amount money that the investor are willing to pay for each dollar of the firm earning. In this case, as you can see here, in 2011, it actually reached to 24.25, and it goes again increasing to 33.06
and it's going to decline, and it's declining again to 22.55. So in this case, investors are willing to pay less money in 2013, and which means it's going to be bad news for the company. And last is the market or book ratio. Market or book ratio provides how the investors are viewing the company performance. And as we can see here, the performance in 2012 is actually very high, as it reached 176.23. Then it decreased again in 2013 to 55.11 cents. This shows that DG Berhad is not doing as good as their performance in 2012. And that's all for my part.
The increase in handset-related expenses was principally due to the higher handsets volumes. This has actually causes the cost of goods sold to be increased. The increase of cost of goods sold has decreased the ratios for inventory turnover. Secondly, higher accelerated depreciation charges being accounted in year 2012 compared to year 2011. This was actually mainly due to the ongoing network modernization programs. The decrease of net profit has slightly decreased the net profits margins. Thirdly, lower broadband tax incentive in year 2012 compared to year 2011. This has caused higher tax expenses for the year of 2012, and hence both net profit margins and earning per share have decreased. The following activities will be the increase in DG subscriber base in year 2013. Due to the consistent internet-focused marketing activities and higher usage from a stronger data networks, DG has actually get a subscriber from 10.5 millions in year 2012 to 11 million of subscribers in year 2013. This has actually bring an effect of average collection period increase due to the increase of sales. Furthermore, the total assets turnover increased due to the increase of sales too. Followed by the repayment of interest-bearing debt in years 2013. This has actually caused total asset at the end of the financial year 2013 stood at 3,752 millions, lower than the previous year, which is 4,014 millions. As a result, interest-bearing debt was lower compared to the previous year, and this has caused the increase of the total assets turnovers and also the returns of total assets. However, current and quick ratios remain the same, as the debt are a non-current liability. Last but not least, the increase in higher net profits from year 2012 to year 2013. This was mainly due to the improve of earning before interest and tax and depreciations. Lower effective tax rate from higher qualifying last mile broadband tax incentive and more efficient depreciations arising from completions of the modernization exercise programs. This has caused the increase of net profit margins and earnings per share. At the same time, it has also increased the returns on total assets.
Our team decides to invest in DG Company after analyzing its latest 3-year financial ratios. The reasons are as follows. After sorting out the financial ratios of the previous 3 years, the first thing we look into is profitability ratios. DG Company's gross profit margin and operating profit margin are both slightly decreasing, yet still remain at a very high percentage. What we care the most is its net profit margin, because we think net profit margin among all the ratios most directly denotes the company's ability to generate earnings for its common stockholders, whom we would become if we invest. In 2012, DG Company's net profit margin slightly decreases from 21% to 20%, yet it increases over 5% from 2012 to 2013, which is remarkable. Same situation happened to its earnings per share. In the meantime, ROA is increasing year after year, ROE is a bit disappointing when compared to year 2012, yet it's still much higher than 2011, ending in stunningly 258.1%. Then we look into activity ratios. Inventory turnover and total asset turnover are better in 2013 than in 2011. Average age of turnover, average collection period are getting slightly inferior, but we don't see it as a problem. After all, it's a normal thing to have ups and downs. But there is one thing concerning us substantially that vacillates us between investing and not investing: debt ratio. DG Company's debt ratio in 2012 is over 90%, and it's still very high in 2013, even though it dropped from 2012. It is known that the higher the debt ratio is, the higher the risks are. So now we see our real concern is the potential risks the company might be facing. After further analyzing, we think the potential risk is mainly from the market instead of the operating capability of the company. If the market is developing well, even if the company doesn't expand its market share, the financial results will be fine. What's delighting is that with the development of technology, more and more people are using smartphones, which creates huge demand for data, and the demand is proved to be larger and larger over the recent years. Thus, we have confidence in the future of telecommunication market, and we don't think there will be serious market risks in the next decade. Back to the point, we don't treat DG's current high debt ratio as a devastating problem. To sum up, we think DG Company is worth investing, and we believe there will be a bright future market for DG to grow. Hence, we decide to invest our 1 million in DG Company.